Hey everybody, this is John Casmon, host of Multifamily Mastery, right here on the Best Ever CRE show. Listen, I'm excited to chat with you today, and I'm going to be talking to you about why your market matters and how to make sure you understand which market you're in and how to find the best markets to invest in today. Let's get into it. Hey, if you are not a member of the Best Ever CRE community, make sure you check us out there because we're having lively conversations and we can keep this conversation going about how to find the best places to invest and making sure you're getting all of your questions answered. Now, this is a great community for real estate investors, especially if you are active and looking to grow and scale. Check out bestevercre.com/community. Now, let's jump into this, right? So, when it comes to your markets and why your market matters, this was one of the things that I struggled with as a new investor. You know, I was based in Chicago and I was buying properties on the north side, smaller multifamily assets. And every time I bought a property, I found myself pushing a little further and further away from the core of where I really wanted to invest. And part of the reason was the numbers just got bigger. You know, the prices got higher as the market picked up, and I couldn't afford the properties in the neighborhoods that I really wanted to invest in. So the strategy that I used to leverage was figure out what I liked about the neighborhoods I did like and which areas were closest to those areas where I could get a lot of the similar benefits. So I would find hot markets, if you will, and find the adjacent market, which wasn't quite hot yet, but had a lot of the similar characteristics so that eventually more and more people would go there and the rents would go and boom and we'd make money. Okay. In hindsight, it's really simple. It's called finding the path of progress. So finding great areas that are desirable, and then just moving a little bit further outside of that. And that's going to allow you to grow and kind of ride the wave of other investors, other developers in that area. Eventually, though, I got into further away. I got a half an hour outside of where I was living, and I started to expand kind of beyond where I felt comfortable investing in Chicago. So I had to start looking outside of the city. And what I found then was, as I listened to other investors, read books, articles, listened to podcasts, videos, none of it really seemed tailored to the markets I was focused on. So I had to really step back and do my own research to learn how to invest. And one of the things that this ultimately led to was me launching my first podcast, which at the time was called Target Market Insights. Today it's called Multifamily Insights. But back then, I set out with one goal in mind. It was to figure out how to find the best places to invest. And through multiple conversations, dozens, and that led to hundreds of conversations, we were able to compile kind of a strategy and the best practices to help investors find the best places to invest. So with that said, the very first thing I will tell any investor, if you are looking to figure out which market you should be investing in, start with your backyard. Your backyard is a place that you already understand. You live there, you breathe there, easy to travel, easy to drive around. Start with your backyard. Even in a city like Chicago, there are neighborhoods that I understood where I could make my dollars stretch. I knew, hey, you want to be in this part of the city, not necessarily that part of the city. And that insight, that local insight, that's going to help tremendously. More important than even the local insight is the team. Right? You got boots on the ground. You can go meet contractors. You can go sit and have coffee with, property managers and leasing agents. So you can sit and really talk to these people and build out your team. When you're investing across the country, it's a lot harder to do that. You're relying on third-party referrals. You're relying on, quick in and out meetings with people. You don't necessarily get the chance to really understand the vibe of a neighborhood or the essence of a city quite like you do when you live in it. So I tell everyone, start with your backyard. Now, a lot of times your backyard is going to be great, but sometimes it's not. It's just not going to work out. And in that case, that is where you want to start to look in other markets, especially if it's more business friendly or investor friendly, then it makes sense to start to look in other markets from that standpoint. But if you can invest in your backyard, look in your backyard. All right. So let's say you can't go in your backyard, right? You got to go to a different city. That's what happened to me. Again, I was in Chicago. I got to the point where I had bought a property in a small neighborhood called North Center. And at that time, the thing I loved was I was a new investor, had never bought a property, and I did a whole bunch of research, and I came across one data point that jumped out to me. And it was the fact that out of 77 distinct Chicago neighborhoods, only one didn't lose any value during the last economic downturn. And that neighborhood was North Center. And I saw that, and it may as well have been flashing bulbs or big, neon signs pointing, you should invest in North Center. And that's exactly what we did. At that point, my wife and I, we just stopped looking at other neighborhoods. We drew a circle on a map around North Center, and we worked with our real estate agent and said, hey, we want to own in this neighborhood. Find us a property here. And we just looked at every small multifamily property that came on for North Center. And then I started to underwrite all of those deals and figure out the numbers, and eventually found one that worked out for us. And that worked great. And I wish we could just do that over and over and over. But as I alluded to, the next time we looked to buy a property, which was about 2 years later, those numbers had inflated and we couldn't get the same value or even close to the same value that we had gotten 2 years earlier. So we started to move a little further out. And at that point, I was working in advertising and talking to a lot of, young up and coming advertising professionals. So I'd always ask, hey, where you live? Where you staying? And people would live in Logan Square, or they live in this neighborhood or that neighborhood. Well, Logan Square was a really hot neighborhood. There was also Lincoln Park, and there was other areas that people loved. And what we ended up doing was we said, hey, the price and the value for some of these areas, the value's already taken. It's already kind of gone up and appreciated. But there are neighborhoods right next to it where that value is still available. And one was called Avondale. And we looked at the numbers. Avondale had a lot of the same characteristics as Logan Square. And it was just a little further northwest of Logan Square. But it was right along the train line, had a lot of the same amenities. And I remember one of the people that I worked with, they also looked at Logan Square and decided to live in Avondale because it was a little bit more affordable. Aha, bright light goes off, right? So we ended up looking in Avondale. We bought a 3-unit building in that neighborhood, and that worked out tremendously well for us. And eventually we bought one more property, the same logic. Again, got priced out of Avondale. Had to start moving out further northwest. We ended up buying in a neighborhood called Hermosa, which I had never heard of. And nobody that I worked with was living in Hermosa. And that's when I started to realize, all right, we're on that edge now, starting to teeter a little too far out from the areas that are really going to see this growth and appreciation. And we may need to start looking at other markets as we move forward. Now, with that said, in hindsight, if I would have known the market was going to keep appreciating, we could have bought directly in our core markets and our core neighborhoods, and we would have been great. But we really wanted to focus on cash flow out of the gate. And we still believe cash flow out of the gate is a really good basis for investing in apartments. So if you're going to start to look in other markets, one of the things you got to look at is population growth. Okay. Because ultimately what we're trying to figure out here is we got to make sure there's demand for these units. So population growth is a great way to gauge that. Now, Chicago as a whole was not growing, but certainly certain neighborhoods were seeing population growth. So it wasn't as impactful for us at a high level, but certainly it can have that overall macroeconomic impact. So as we looked at population growth, we looked at different cities throughout the Midwest and really wanted to lock in on Cincinnati because we have family ties there. So Cincinnati was a market that we liked. It had good population growth. Not record-breaking growth or anything like that, but it was solid and very respectable growth. And that was something we really paid attention to. Beyond the population growth, we also wanted to make sure that it was great for business, okay? We wanted to make sure that there was great job growth there and that there were diverse industries. And this was critical because I started my career in Detroit working in the automotive industry, and I watched firsthand what happened during the last economic recession. I watched that city get pummeled when the automotive industry collapsed because so many jobs relied upon the automotive industry, even jobs that weren't directly tied to the automotive industry. Think about your dentists, your plumbers, your real estate agents. Well, if all of your clients have jobs tied to the industry, then it's going to have an impact on your business as well. And that really depressed prices, real estate values dropped, and anybody who owned real estate at that time was looking to get out of it. There weren't very many people who were bullish on the city. As a matter of fact, if you recall, there was a time when you could buy Detroit real estate for like $1 or $10 or something like that, literally just to pay the taxes is all you had to cover. And I knew people who were doing that. I didn't know them at the time, but shortly after I found out there were people who were doing that. And that's how depressed the property values had gotten in that market. And imagine if you were one of those owners and you bought a property for a certain amount of value and you just watched it depress and drop all the way in value. Probably not that bullish, right? But for those who were, they ended up recovering and doing well. But I remember at that time, no one was feeling that way. Everyone felt that, hey, this was awful. Get rid of whatever you can, get out, run. And this goes back to investing in markets that have diverse economies, because even when you face an overall economic downturn, it'll be softened by the fact that other industries may be doing well. And in our case, when we're in Detroit, we just didn't have that because so much of that city relied on automotive. Now today, tech has come in, other industries have come in, and it started to lift and diversify that economy. But that's one of the things that we always look for is a diverse economy with different industries, different companies, where one company taking a hit or one industry taking a hit doesn't distress the entire city and the entire market. So it's a really important thing to pay attention to. The other thing that we're paying attention to is we're looking at the overall climate when it comes to multifamily. It's very easy to get caught up in what happens in the economy and population growth. But what we don't always factor in is how do people respond to that? Developers. We've seen more recently some of these cities that have had great population growth, great diverse industries, lots of jobs coming. Well, guess what? Developers read all the same headlines and they rush out and they start building all these new apartment buildings. And you realize that sometimes there's an unequal amount of apartment units that are being built and being developed versus what the demand is for those apartment units. So understanding that supply and demand push-pull strategy, that's something you got to pay attention to as well and understand if and when it makes sense to invest in a market. So those are some of the things that we were paying attention to when we started to expand outside of Chicago and ultimately moving into Cincinnati. But even once I landed on Cincinnati as a market, I really had some challenges to figure out, okay, well, how do I now figure out where to invest in Cincinnati, right? Cincinnati is a large city, may not be as big as New York or some other markets, but it's still a major metro. And figuring out which neighborhoods or submarkets to invest in proved to be a challenge. So one of the things that we started to do was we talked to different locals and we would get feedback from other investors. And through all these conversations, some folks would say invest on the east side. Some would say the west side's the best for investing. And I realized I really didn't have a clear criteria of what I was looking for as an investor. So I had to step back and really learn the city, but also learn about myself. And that's something not enough people do. You have to understand what you're comfortable with as an investor. Do you really want the highest cash flow potential? Do you want a quote unquote safer / more desirable neighborhood? Do you want more of a trophy asset? What do you really want to invest in as an apartment investor? What do you want to have as an owner? That is going to help drive which part of the city, which submarkets you should be paying attention to. For me, I wanted to blend. I wanted the blend of cash flow, equity, and upside appreciation potential. We wanted to focus on value-add Class B apartments because we felt it was the best of both worlds. Desirable assets where people would want to live. There would be pretty solid, strong demand for these assets, but enough cash flow potential where, we could make money and it could be prosperous for us. And trying to find that balance, it can be somewhat tricky. We didn't want to do rough and tough neighborhoods, but we also were not investing in luxury Class A assets as well. So for us, as we started to think about that and think about who that resident looked like and where that resident would live, the neighborhoods that we wanted to invest in became a little bit clearer. So people like to ask me, hey, John, how do you find that best market to invest in? One thing I will tell you, get clear on the kind of asset you actually want to own. And that comes down to the criteria. What kind of returns are you looking for? What is your investing horizon? Are you self-managing or are you working with a third-party management company? If you're working with someone else, what are their skill set? What's their comfort level? What neighborhoods do they manage in? Like, you really need to figure all this out before you just lock in and start shopping for properties. Make sure you have that clarity, because that's going to make your job easier of knowing what you're looking for, but also for those folks you're partnering with. If you're working with a real estate agent, they want to make sure you know what it is you're looking for so that they can go out there and find that opportunity and bring it to you. So the first deal we did in Cincinnati was actually a 28 unit building. We bought this property it's actually a separate city. It's called Norwood. It's a city within the city of Cincinnati, but completely separate from the city. And Norwood's an interesting place. But the thing that I loved was, as I did my research and I talked to people, we figured out that the path of progress in Cincinnati was really on the east side. And it was along this corridor called the Montgomery Corridor. So it was like, if you go to, there's a street called Montgomery, there's a city, a little city called Montgomery within Cincy. And if you follow that pathway, that's where a lot of the growth and development was happening. That's where a lot of investors were pouring their money into. And you even see it to this day. There's developments that are happening along that corridor. So that was something that we got excited about. So again, just like on that first property, we just kind of circled the Montgomery Corridor and said, okay, we're going to look for properties in this area, and we know what our return criteria is. If we find properties in this area that fit what we're looking for, we're going to go ahead and place some offers on those deals. So it took a little bit of time, but eventually we got a deal that came up. It was off market from a broker who I built a relationship with, and we liked the property. It was an older property, needed some work, but we still liked it. We went ahead and put in the offer. Couple things stand out about that location. Again, when we talk about the location itself, it was in a highly desirable location. I remember at the time, Uber had set up an office not too far from there. It's along what's called the Norwood Lateral. So the infrastructure was right off 71. The Norwood Lateral kind of runs east to west, and it wasn't too far from 75. So you have two major highways that have close access, plus the lateral is another major street that kind of gives you access throughout the city as well. And a lot of companies were developing along this path. That was very attractive to me. We had some malls, Rookwood Commons, some different pavilions that were built up. I liked the restaurants that were there. And at the time, I remember the SC Cincinnati team, they were getting ready to build their stadium. And one of the rumored sites was going to be right there next to where the property was in Norwood. So that was really attractive for us to go in there and invest in this area. And I think we did a really good job of picking that submarket, recognizing the growth and development that was happening all around it. So if I'm looking at those micro or those submarkets, I'm paying a lot of attention to who else is already there and who else is looking to come there. What are they building? What are they bringing? That's going to help do a lot of the heavy lifting when you are looking to invest in a submarket. So again, I wouldn't listen to just whatever someone says on an internet forum or even a podcast like this, but pay attention to your criteria, get clarity on that, and then pay attention to what others are doing in the area. One of the great things I like to check out whenever I'm looking at a new location is I like to go to the local economic chamber of commerce. Now, it's a little bit different in every city and every market, but check out what they're talking about. What developments are in the pipeline? What kind of discussion is being had about developments? Which areas are poised for growth? Do they have areas that are pinpointed to say, hey, we're going to place an emphasis on developing this location? That's going to help give you the clarity you need to say, okay, they're looking to invest here. This company is already coming here. Let's go ahead and figure out where we can make investments alongside the other investments that larger investors are going to make in this area. So when you're finding those places to invest, those submarkets, those macro markets, ride the coattails of those big developers. That could be large institutional level investors. It could be government officials or kind of the government grants and foundations that exist. It could be existing companies in that local market, but let them do the heavy lifting on the research. Let them tell you what they're going to invest in, where they're going to invest, and ride that development. Again, I'll go back to my time in Chicago. There was a study that was done, and they were going to be opening up some new infrastructure for the public transportation. And at the time, I was working in the West Loop in the meatpacking district. And this was back in, let's call it 2013, 2014. And I remember seeing that they were going to open up a new train stop right there in the West Loop. And sure enough, at that time, there were like two places that I would go for lunch, right? There was nothing. There was like a little sandwich shop and something else, but you didn't have a lot of food options. Well, they made that announcement. And let me tell you, over the next 3 to 5 years, we saw major buildings get constructed. That meatpacking district was truly, when I first started there, like we had to share a parking lot with the meatpacking companies. All of that ceased. They got wiped out. Big development came in, hotels, corporate offices. Google now has a headquarter or a Chicago office there. I believe a few other, Facebook has a big office there, Meta. A lot of big companies came in once that infrastructure was developed, because that public transportation really is a staple for a city like Chicago. So following kind of that path and those announcements was a huge, huge opportunity. And I wasn't really investing at that level at that time. But if I could go back, that's one of the insights I would take away is if you're in a major city that's public transportation, pay attention to those developments. I remember talking to or hearing Kathy Fettke speak at an event. Actually, it was Best Ever Conference. By the way, Best Ever Conference coming up for 2026. Make sure you check that out and get your tickets. But I remember hearing her speak, and she talked about Dallas-Fort Worth. And she was mentioning that back, when she was first starting to invest in Dallas-Fort Worth, they hadn't built out the interstate that kind of surrounded the suburbs. And once that happened, that's when DFW really started to take off. And that infrastructure development is huge because it makes cities accessible. It makes suburbs accessible. And if you can do that, if you can figure out where that's happening, that gives you an edge as an investor. So make sure you're paying attention to the infrastructure development. Again, you can get that information by plugging into the local economy, local economic chamber of commerce. That's where you can uncover some of that information that's taken place. So from there, we had that property in Cincinnati. Things went really well. We ended up selling that a few years ago, but really, really enjoyed watching that area continue to grow and evolve. We saw other developers come in even after we were there and develop in close proximity to us. And that helps the valuation, right? You certainly want to buy for cash flow, but if these other developers come in, that's going to make that area grow in demand. And ultimately, as investors, it's all we're trying to do, right? We're trying to figure out areas where we can invest in, where the demand is going to be higher in the future than it is today. And if you can keep that simplicity in mind, it makes it so much easier to find the right places to invest. Certainly, there are way other variables you got to pay attention to, but I like the simplicity of that. So let's talk about why your market matters a little bit more, right? Today, a lot of the strategies and tactics that investors have employed, they worked great over the last decade. But today, especially over the last few years, we've seen that, markets do matter. And the national headlines tell one story. If you've invested in, some of the markets that saw explosive growth, the early part of this decade, maybe those markets aren't doing as well today. And part of it is, the population growth that those markets saw. Some of that's continuing. Some of that has slowed down, but the development that has happened to coincide with that population growth, what's ended up happening is it's outpaced the demand. And as new supply has come online, it's really forced rents to go stagnant and in some places decline. And that's not happening in every market across the country. Okay. Sometimes the headlines make it seem like that's the case, but it's not. In our markets, primarily Midwest markets, we are not seeing that. Even in markets where we're seeing new supply come online, we are still seeing respectable, if not strong rent growth. And part of the reason is, again, it comes back to supply and demand. In those hot markets, I think developers got super excited, came out. Everybody wants to take advantage of that. A lot of folks started developing, and now that supply and demand started to get out of whack. Okay, there's an investing rule people look at. It's net absorption rate, but they're trying to pay attention to how much demand is there really for these properties, for these units that are coming online. And net absorption rate, what it does is it tracks how quickly these units are occupied. They get taken off the market. And it's a little tricky to figure out if you're a newer investor, but it does give you a pretty good gauge of how much demand there is for this new property, but also how much supply is in the pipeline, how much new demand is coming there. So that's something we pay attention to. In a lot of the Midwest markets, you did not see quite as much growth in terms of new supply. You know, population growth is there. It's not as strong as some of the West Coast markets, some of the other markets, but the new supply is not as strong either. And that's the reality. We can get caught up in a number like population growth, and it's certainly a very valuable and valid information and valid stat. But the truth is, it's not the end all be all. There are a lot of other data points that you should be paying attention to. We've talked about population. We've talked about job and industry growth. We've talked about, what's happening from a renter standpoint, supply and demand. You've got to factor all of these things in together when you're paying attention to your markets to figure out where you want to invest and where you want to go. So those are the things that we pay attention to. You know, as we start to grow and take a look at markets, you know, we mentioned what's happening in some markets across the country, but our investing philosophy has always been, hey, you know, where can we get really good cash flow out of the gate, and which markets are poised to have good growth? So for us, you know, we look at a market like Louisville. Louisville, Kentucky is another market that we've invested in, and Louisville had really solid cash flow. We like the growth. We like where it's positioned geographically in the country. And we spoke to other investors. It's a solid market. You know, most people don't wake up super excited about Louisville, Kentucky. It's not going to get everybody, ecstatic, but sometimes that's exactly what you want as an investor. You know, you don't want to be in the market where everyone's excited about it, because guess what? Everyone's going to be excited and run to it and, you know, push up the pricing and the valuations, and maybe you can't get great deals anymore. So I like the fact that it was a little bit of a quieter Midwest market. But as you dig deeper, I like the things we saw. Again, population growth was there. It's pretty solid population growth. I like the fact that it had industry diversification. I love the fact that it had logistic companies there, you know, UPS. It had colleges and universities there. It had healthcare. Those three industries in particular are fairly recession resistant. When you talk about logistics, healthcare, education, those tend to do well during good times, and they still do well in down times. So I like the fact that this was more of a recession resistant market when it comes to the industry. The companies that were there were larger corporations that had a great mix of things. But even when you look at it just geographically, it's just well positioned on the map. You know, when you look at trying to travel and get to most places within a day, it's close to Tennessee. You can get to Nashville. It's 2 hours away from here in Cincinnati. You can get to the West fairly easily as well. And I just like that from a geographic standpoint of the accessibility of this market. And the reason that's important is that's what other companies are going to be looking at. You don't want to have your company where you've placed your headquarters in a place where it's really hard to get your product out to people because you're constantly having to travel all over the place and your shipping costs are high. So if you can be geographically centralized, it's going to make it a little bit easier for you as a company. And this is one of the things when it comes to logistics that we do believe companies are paying attention to today. You know, if you are an Amazon or you're in charge of cargo and logistics and transportation, you're going to be paying attention to these kind of factors when you're thinking about where you want to set up shop or where you want to open up a distribution center and things like that. So I think it's really important just to kind of keep that in mind. And the other thing I love was when we look at the market itself, there was pretty good development, lots of development and new supply that was coming online in the market. However, most of it was centralized in one part of the city. And when we talk about the submarkets, what I liked was there was no new supply in the submarket where we invested in, and we bought a newer property, but there was really nothing new in the pipeline. So we had a newer property that was really competing against older housing stock. And we thought that gave us a competitive edge. So that was something that really stood out for us. And one of the reasons we like that asset and that submarket in particular is trying to really craft that opportunity where if you were a renter, why would you want to stay in one place versus another? And we felt like that gave us a really good competitive edge in that particular market. So that's just one as an example. But as I look across our portfolio, every market we've invested in, we've really loved the story of the market. We did San Antonio, Texas about, 8 or 9 years ago. And at the time, San Antonio was still growing. I know it's growing now, but population was there. A lot of investors were focused on DFW or Houston. San Antonio was kind of a little more quieter Texas market to people at that time. Some folks were big into Austin, but Austin was a higher priced market. But I love the proximity. Austin to San Antonio, they're about, I think, a little bit less than an hour away or so from each other. So we like that. We like the affordability of San Antonio. And we love the fact that we could go in, be in a solid submarket in that area, get some great value, but also knowing that we anticipated, hey, if you like DFW as an investor, if you like Austin as an investor, you probably would have liked San Antonio. And as we anticipated, more and more investors started to pivot towards San Antonio for the same reasons that we liked it. So even though we're talking about a macro market, we saw a similar progression where people were looking at one market and they started to pivot to the next quote unquote affordable market, which obviously drove up the valuations. So those are the kind of things we paid attention to early on. We love the San Antonio market, a lot of great factors there. Some things when it comes to supply and demand, those are cyclical. So for us, we're not in Texas. We're not really close to Texas. We haven't really done anything in Texas in a long time, but we know that there's still a lot of great value there. We focus primarily on the Midwest, but we like markets like Atlanta as well. We've done deals in the Charlotte markets in North Carolina, South Carolina as well. So those are the things that we always pay attention to, though. As we're looking at our markets, we want to know the story. We want to know the population growth. What jobs are there? What industries are there? Are these recession resistant, or do we have some kind of exposure? Who's our tenant base? I remember, when we were starting to invest, we had some markets where we had a strong Latino tenant base, right? So we had to make sure we understood how that would play out, particularly when we had new administrations come in and maybe they weren't as favorable to immigration and things like that. You have to understand how this could impact you as an investor. So those are some of the things we paid attention to early on. And this is also why your market really matters, because you need to understand some of the factors that can make you money or that can hurt your ability to generate cash flow. I want to get into a little bit of Q&A because we do talk to our investors all the time. We talk to other folks looking to grow and scale in multifamily. And oftentimes I'll get questions. And I got a question yesterday that was really kind of eye-opening. And this person lives out west, up in Washington, but they were looking at a deal in Los Angeles and they asked me to review it for them. So I'm looking at this deal. And as we get into the numbers, there's a lot of numbers all over the place. I remember there was one bedrooms that were renting for like $900. And that same square footage, same layout, one bedroom was also renting for like $2,500. And I'm like, wow, that's a little wow that there's such a wide range and a wide gap in these units. And one of the things that we started talking about was, understanding that some markets might have rent control, or you might have, say, subsidized housing in this community or in this housing or this property. And when you start to layer all of those different things together, it gets to be something where you really have to understand how things operate in that market, because rent control, again, there's only a handful of markets where you have that. That's something that continues to, be challenging for investors, and something that, affordable rents are something that, politicians are certainly pushing for. And I think most Americans want more affordable rents. But I think there's also a right way to do that and a wrong path of doing that. And when it comes to rent control, as an investor, that could really limit your ability to execute your business plan. So if you go in and you underwrite a deal, you think you're going to push rents to $2,500, but you're not aware of rent control and how it actually operates and the minute details of how to navigate that landscape, you could really be setting yourself up for failure. And on top of that, you take in government programs, vouchers, especially when there's whispers or roarings that some of these programs are going to be either wiped away or pushed down or cut in half. That's something that could have a major impact on your business plan. So if you're looking at a market, you have to understand both from a national narrative, what's realistic, what's happening, but also that micro market, because some of those funding programs, the grants, that can impact and change very quickly. I'll go back to our Louisville property. During the COVID time, we had residents who were taking advantage of a Kentucky-wide program where they could get housing support, but they had to be behind on their rent payments. And that was something where, we didn't love it because we felt that there were people who were abusing the program. If you really needed support, fine, we get it. Like, we want to help you get the support you need, and we're happy to be flexible and work with you in that situation. But the program really incentivized people not to pay rent. And residents would tell us flat out, hey, I've got the money, but if I don't pay and I wait until this date and I wait for you to send me a notice, then I can go and get free money from the government. They were savvy renters, right? So they found a way to pocket money and save. And as we talked to them more, our viewpoint was, okay, you can do that and technically we can accept it. But one, we're going to monitor this when it comes down to renewals, because at the end of the day, you're still late. And that's going to hurt our ability to trust you as a renter who is going to pay your rent on time. But the second thing is at any moment, they could run out of funding or something else can happen. If you're playing this game, that money may not be there for you. And that's one of the things when you're investing, especially if you're investing with the mindset of, I'm going to go into a submarket and I'm going to rely on government programs or something like that, some sort of subsidies. You need to understand the funding. Where's the funding coming from? Is it national? Is it local? Is it statewide? Is it pre-funded? Is it something that could run out this year? What happens if your business plan is relying on this funding and that funding disappears? So those are some of the things that you got to pay attention to if you're investing in these areas and you have a business plan that heavily relies on funding. So whether it's the macro market or it's the sub market, you have to think through some of these different strategies and iterations of how you can tap into the funding and how it all comes together. So with that said, I want to give you a couple more things to think about. When I'm looking at markets, I'm paying attention to population. That's relatively easy to find. You can Google it, but I usually go to the U.S. Census Bureau. You can just go to census.gov and find most of the information you're looking for there. When I'm looking at jobs and industries, that's available from the Bureau of Labor and Statistics. So you can check out that information there, bls.gov. And when I'm looking at comparing markets, one of the things that I found is those government websites, they do a great job of gathering the information, but a terrible job of presenting the information. So it's really hard visually to make it work for what you're trying to find. There's a website I love. It's datausa.io, and it does a great job of just visually representing the same data, but in a more visually aesthetic way that is great for investors like you. If you're more creative, it's great to just lay it out and see it in charts and graphs, and it helps you really see the story in a more compelling manner than just trying to figure out those charts and what the census.gov has to offer. So check out datausa.io. No affiliation with them, but I just love the way they lay out the data. And the other thing that you're going to pay attention to, for me at least, is I'm always trying to pay attention to what's happening from both a crime standpoint, but also an income standpoint. So when I'm looking at different resources, I'm trying to pay attention to my neighborhoods. I know a lot of people like City-Data to get that information. There's some other great websites that have that. But again, you want to tell the full story of where you're looking to invest and how that investment's going to grow over time. When we bought our property in Florence, Kentucky, one of the things that jumped out to me was the submarket, because when we looked at Florence, I wasn't as familiar with Florence as a city. Very familiar with Cincinnati. Florence is just the other side of the river in Kentucky, just a little bit further down. And as I did my initial research, the data point that just jumped out at me, just floored me, was Boone County had seen this. Boone County is where Florence is located. So the county where this city is located had seen 30 years of straight population growth. And that just floored me, because you expect to read that for large cities or, vibrant cities that are growing on the West Coast, or Phoenix, the Texas markets. Like, I would expect to see that there. Little Florence, Kentucky, Florence, y'all, like, you don't expect to see 30 years of straight population growth. So that to me told me a great story that, hey, whatever is happening here, it's not by accident. It's sustainable. It's intentional. Like, the government, the community, it's built in a manner to foster growth. They want to grow. It's not a little small, sleepy town that's just happy, doing whatever they do and getting whatever they get. They're deliberately looking to invest and attract and grow this market, this economy. And it made me want to look into it more to understand what it was they're doing. A couple things jumped out as I did more research. One, they were they had the airport there. So that's one of the big things. CVG Airport is located, in Boone County. But on top of that, they got Amazon to invest $1.5 billion to build out their own air cargo hub. Huge investment from a large corporation that demonstrates the viability of that area, adding a ton of jobs. The second thing is just, again, infrastructure. Right off of 75, 71 is close by as well. There's a lot of infrastructure and connectivity, making it easier to navigate and get around. You can get straight up to Cincinnati, get to downtown, straight down to Louisville, get down to Lexington, all within an hour and a half, 2 hours drive from Florence. So that was something that was really attractive for that area as well. And then you look at the industries, the jobs, the diversification, it's all there. And it's there because there's a dedicated economic council that is fostering growth. The governor to the local officials, they actually have a progress report that they look at quarterly. They have quarterly goals on business growth. How many new jobs have they added? How many new employers have they brought into the market or into the area? They are tracking this data. They have clear goals and a clear vision to grow that market. And that's something as an investor you want to see. You want to see that the local market is dedicated to growth. See, a lot of times you get this NIMBY mentality where people want to grow. They say they want to grow, but then they bring development ideas, or they want to bring in these companies. You also need land. You got to develop this stuff. But once they hear that, they start to shut it down because they want to grow, but they just don't want you to grow in their area. And you have to have an environment where people truly are committed to fostering that growth. They're offering incentives. They're offering economic packages, grants, whatever it is and whatever it takes. You've got to be able to commit to that. And in Boone County, they've been able to do that. So when you look at that data, you look at the numbers, that's how they've been able to grow for 30 years straight. That's why they're poised to grow for the next at least 5, 10, 15 years, because they are committed to fostering an environment of commitment and growth. And it's funny, since we bought that property, they've actually grown the infrastructure. They've added some new exits off of the freeway. And I've seen it now when I drive to my property, they've added new stores, new developments. It's funny because you can just see these communities change and grow based on all of the development that they've talked about. Well, I've watched it happen over the last, 3 or 4 years where they talked about doing something. They've done it. There's more developers there. There's more housing there. There's more jobs there. And as an investor, that's what you want to see, right? You want to invest in these communities where other people are just as committed to the growth and development as you are. And that allows you to ride the wave to success. So I hope this is helpful. If you have questions about finding markets to invest in, looking at the right data points, and figuring out what questions you need to ask. Let's get online. Okay. We got the best ever CRE community. We can get into a conversation there. Just go ahead and make a post, tag me in it. I'm happy to comment and weigh in. Let's get a lively discussion going. I want to make sure we can answer your questions and build a great community of best ever commercial real estate investors. Just go to bestevercre.com/community and join today. Or if you're already a member, just go ahead and start posting, get active on there. Tag me in your post. All right. Hey, hope this was helpful. If you have any questions, feel free to reach out on the Best Ever CRE community. And I look forward to talking to you again soon. This was John Casmon with Multifamily Mastery right here on the Best Ever CRE show.